Hey everyone, how's it going? My name's Austin Hankwitz, and this is Katie Stockton. I'll let her introduce herself in a second because she is doing everything and anything under the sun as it relates to technical analysis. She's quite the wizard. You might have seen her on CNBC or anywhere else that really hosts awesome people. But before that, let me kind of walk you through our thoughts right now on what the next probably 15, 20 minutes of conversation are going to be about. So as we all saw, the markets yesterday after Jerome Powell confirmed that he will not be doing these 75 basis point rate hikes spiked. We saw 3-4% gains across not just the markets, but also cryptocurrencies and things of that nature. And then today now on May 5th, it's not as bright and rosy. Everything is selling off and everyone's panicking. What's going on? What's going to happen? Where are we in this market cycle? Is there a recession around the corner? We're going to be talking about all those different things. But before we do that, Katie, would you mind introducing yourself?
Of course. Thanks, Austin. So again, Katie Stockton, and I founded a company called Fairlead Strategies in 2018. Before that, I was on Wall Street for the most part for close to 20 years, maybe close to 25 now at this point, working in technical analysis. And it is my expertise. And technical analysis, the way I see it, is the study of price trends, which of course reflect all the supply and demand in the marketplace. So we use a lot of technical indicators. So these are mathematically based tools to understand price action in the markets. And we've been doing something similar to what we're doing now, really over the course of our career. And we actually recently launched an ETF, so that's exciting too.
Oh, are you okay?
Oh, yeah. Yeah, sorry, I just stopped. I was giving it back to you.
Oh, did I lose you? Did something happen?
I don't know.
We can always cut that out because this is just recorded.
Okay.
All's good. So maybe start with you just started an ETF.
Yeah, and so we recently launched an ETF, which is really exciting for us. It's a very natural byproduct of what we're doing here at Fairlead, which is publishing technical strategy research. It is primarily U.S. equity centric, so we focus a lot on the S&P 500, and we do a lot of idea generation. So we have research that we send to clients who are either the retail individual investor or the big asset manager. It really runs the gamut in terms of who uses our research because it applies to just about everyone who's interested in investing.
We will definitely be talking about that ETF. I'm really interested to learn more about that. And to you guys who've been sticking around for a while and have been following me on Substack and Twitter and TikTok, you guys might recognize Katie's face. We've hosted, I want to say maybe 3 or 4 of these 20, 30, even 45-minute long discussions walking through where the markets are. And I think the last discussion we had was at the top. I think we walked through a discussion around, I think it was maybe December or January. Things were very frothy and exciting back then. Things are a little bit different now. So Katie, would you mind spending some time walking us through probably the poster child of the things aren't doing too hot anymore ETF, and that is ARKK. We've seen ARKK do a lot of fun things over the last, call it 2 years. Cathie Wood's been buying left and right Roku's and Teledocs and all the fun, crazy COVID companies, COVID stocks that we know and sometimes loved, but perhaps not loved so much anymore. And ARKK, I believe, hit its top in February of 2021 and has since been trading down. People have compared ARKK to what the NASDAQ did in 2000 with the dot-com bubble. Where are we in comparison? If that was a true comparison, where sort of are we in that cycle?
You know, it's funny because I feel like it was nothing like the late 90s, quite frankly, what we saw in terms of the run-up in ARKK. Can you see the screen okay, Austin?
Yes, I can. Yes.
Okay, so here's the run-up, and here's your peak from February of 2021. And of course, the downdraft that ensued, that has really accelerated recently, and that's shared by, at this point, the broader market. So this market has now rolled over, of course, lost upside momentum, and the weakness in these kind of higher growth areas of the market, like ARKK stocks, has now carried over to even the mega caps. So you've really seen a spreading out of that decline, and yet we've gotten no relief really yet at all for ARKK. You can see this downtrend if you look at the moving averages, they're all pointing lower. They're all still diverging. And yet, if you look at this indicator, which is called the MACD, it's actually less bad. So as we've come down over the past few weeks, we've seen a loss of downside momentum on an intermediate term basis. That is somewhat promising, and yet there is no support right near current levels for ARKK. So there is still some risk. If you look back at this March 2020 low, we all know that was the COVID low. That's just above $32 for ARKK. And of course, that's a little bit uncomfortable in terms of room from current levels. So we think there is still some risk with the long-term momentum to the downside, but with intermediate term momentum having alleviated a bit to the downside, that perhaps there is a floor for these high growth areas of the marketplace. The other thing I would highlight is that unlike other areas of the market, ARKK and similar setups are actually pretty oversold from a long-term perspective. This is a monthly bar chart, and while it has limited price history, so some of the indicators look a little bit messy, this is the stochastic oscillator, and you can see an oversold reading in here. And that oversold reading is being affirmed by another one of our tools that's based on the DeMark indicators. Probably getting too technical with you here, but it does suggest that this downtrend is actually exhausting itself as it comes into this shaded area, which sometimes acts as support. So we have some hope for ARKK and the likes, but we're not ready to say we're ready to get back in full force. We'd rather wait until we actually see momentum shift to the upside, at least from a short-term perspective, for more than just a day or two. And in this tape, we've had a lot of volatility on a day-to-day basis. We really are putting some emphasis on risk management and also confirmation of turnarounds, of breakouts, et cetera.
So thanks for doing that. The first thing that you said, and it's kind of turning in my head, and I want to hear your perspective on this, Katie, was you said we can't compare ARKK to what happened in the .com and what the NASDAQ was doing. What could you talk more about that?
I know it might be surprising. It really just felt different. So I was in San Francisco during the .com bubble, which was very fun, by the way. And yet, we would come into the office every day. Things would be up, and not just up; they'd be up a lot. And it just felt like day after day we'd have up 3%, up 4%, up 2%, and it just felt like it was continual in a way that I don't really feel like we had that same sense in the run-up ahead of February's peak in ARKK. It was certainly a strong uptrend, but it didn't have that same kind of parabolic nature to it in the charts. So it wasn't quite as steep. It didn't accelerate in the same way that the dot-com bubble did. And, of course, the pop, if you will, wasn't quite as dramatic either. It ultimately did give way to equal, if not worse, in terms of the percentage decline, but it wasn't quite as abrupt. So the whole thing feels a little bit different than the standard bubble type of environment, but that doesn't make it any better or any easier. It is a bear market move for these high growth names, so we need to navigate it that way.
Got it. Okay. So as we move on, though, something that you mentioned too was we're looking for these confirmations, right? And I think what I've been able to kind of see on other different, I think it was like Twitter and people are saying, okay, because I've been trying to figure this out too. There have been people that are saying, okay, when it comes down, we want to see it go up and then go up above this sort of resistant, come back down to this level to say, hey, here's kind of where we're at, but then continue going forward versus come down and touch that and loop. So walk me through what's the perfect scenario for something that says, okay, we're now looking for these confirmations. What is a good confirmation? How do we know that something is confirmed one way or the other?
Yeah, I wish there was an easy answer to that because it really depends on what setup you're trying to identify. For a breakout, though, for example, we would like to see more than just one day above a certain level. And that way you eliminate some whipsaws because that's pretty common in the marketplace these days. There's a lot of people with their eyes on important support or resistance levels. And because of that, they kind of get gamed, I think. People will try to push it above briefly and it becomes this bear trap or bull trap. So we always wait for more than a day, even in some cases more than a week if it's a longer term level, a more significant level. So we like to see 2 consecutive Friday closes above as an intermediate term breakout, that type of thing. In terms of a turnaround, which of course you wouldn't be seeing a breakout, we would look for something from the indicators. The one that I just showed with ARKK, that was the weekly MACD indicator, a very common technical tool. And its design is to eliminate some noise from the market and also shift when there's important shifts in trend. So by the time the MACD crosses over, you should know that we have some kind of important peak or trough in place. We have these indicators to help us know if there's a shift underway with some level of, sort of confidence.
Got it. Okay. And then I guess the next thing we should talk about, and you kind of called this. I mean, you literally in our last, I remember we were sitting here, I was talking about how cool I thought Amazon was and how excited I was. And you're like, well, the technicals are telling us there could be some downside in the near future, right? There's not too much, say, support to keep us above a specific level. And you were pretty correct here. Amazon's earnings pulled it down a lot. And I did a analysis on Amazon's earnings, and I concluded that there was problems with solutions, right? It was a lot of problems around headwinds with shipping costs and scaling quickly and things of that nature, but these problems have solutions. And so I, generally speaking, and am still pretty excited for Amazon in the long term, but walk me through the sort of fall from grace again for one of the largest retailers, if not the largest e-retailer in the world.
Yeah, it's definitely a shift that we've seen now. These mega caps exhibit downside leadership at times. It's not something we're really accustomed to, quite frankly. So I do think it's an important thing to be respectful of the loss of momentum here. So for Amazon in particular, you can see that it's been trending higher up until it was about December, or no, I'm sorry, that was a November peak. And subsequent to that, we saw a breakdown. And for me, the breakdown was below the shaded area, which is called the cloud model. It's just a sort of a trend following gauge, a good gauge of where buyers should theoretically step in. And of course, for Amazon, they didn't. They didn't step in there. And that to us becomes a breakdown. And that breakdown told us that Amazon had entered a downtrending type of market. Now, notice here when it saw some downside follow through, we got an oversold reading, and the subsequent relief rally took it right up into the cloud, which is a resistance level now. So the what was once support becomes resistance, or a natural place for sellers to step in, and that's exactly what happened. So it failed right around this cloud, and then, of course, proceeded to break down, as you mentioned, in response to its earnings report. So investors didn't find much positive about that report. And unfortunately, that's been the case a lot during this earnings season. In April, we saw an 8.8% decline for the S&P 500. And during that month, we did see a lot of companies report earnings. So overall, they were not well received by the marketplace. What's interesting is that Amazon had very good support around these lows here. This was from January and then tested in March. And that was around 2,700, based in part also on a 50% retracement level of this uptrend. And below that, this is the next support is shown in green here. That's about 24.46. Of course, we're well below that at current prices. But that's being tested. We don't have another confirmed breakdown. But what we do when we see these breakdowns is we use the next support level as a guideline as to what downside risk might be. So we're hoping that Amazon can manage to hold this 24.46 level, because that would tell us that, okay, well, the buyers have found interest in the stock at that current price. So we really want to follow on with these levels, make sure that momentum shifts enough to suggest that we have a buying opportunity before so-called catching the falling knife. You've probably heard that phrase before.
Definitely have heard that phrase before. So with Amazon moving lower and you're showing, big mega caps have done the same. We've seen Tesla move around a lot. We've seen Microsoft and Apple move around a lot. How low can we go, right? How low can we go? We look back what would happen in 2008. We look at what happened in 2000. We even look back before that. And we kind of can begin to look and see at the very peak and compare that to the bottom, right? And see, maybe that was 30, 40, 50, 60% of a decline. Where are we in that cycle? And Is there anything that maybe you are doing right now to prepare yourself for either a lower downside future, or just like walk me through your kind of logic here?
Yeah, so we haven't entered a downtrend as of yet for the major indices, but we're awfully close to that in my work, because if you look at the S&P 500 and also the NASDAQ 100, which we consider to be really the benchmarks for the market, those are testing some key support levels. For the S&P, we're watching about 4,200. And for the NASDAQ 100, the level we're watching is roughly 13,000. Now, if we see those consecutive weekly or Friday closes below, that becomes a breakdown. And that could happen as early as this week. So we really have sort of a tenuous setup, because to us, below those levels, it becomes not a trading range, but rather sort of a downtrending move. And you might have heard of a head and shoulders top. It's something that has the shape of that if we do see these breakdowns. So the head and shoulders tops, they're really a way to describe the shape of the trend as having sort of a lower high following a higher high. And of course, that reflects a loss of momentum. The implications of those longer term sort of topping formations, they tend to be months in duration. So we don't exactly have a great feel for where it goes. We can certainly make an educated judgment as to where the next support level is, but we can get certainly an indication of maybe the time frame over which this kind of move could unfold. And usually the head and shoulders setups, when they're completed, still have several months of weakness in store for the market. So that's what we fear may be happening. And if it doesn't happen this week, it could certainly happen 3 or 4 weeks from now. So that puts us out into Q4 of this year at a very minimum for more of the same in terms of market volatility. I know that you've been saying that in your work as well, that we can expect a lot of volatility this year. And indeed, the charts would confirm that. So it tells us that we should perhaps be patient when looking to add exposure. But what I would note is that, because the higher growth areas of the market are more oversold from a long-term perspective, I don't think that they're going to be the source of downside leadership that they were before. If we do get this downdraft continuing here, I think it's more likely going to be the mega caps and perhaps other sectors even besides technology and consumer discretionary. So it'll be interesting to see how it sort of unfolds, and perhaps some of the names do have a floor to them, but it feels right now like it's pretty tenuous.
Got it. Yeah, it's certainly frustrating to see big companies like Amazon shed 7, 8, 9, 10% in a single day. It's like, wow.
And we'd already seen the Meta or Facebook. We already saw Netflix break. These are really broken charts, unfortunately. And I know everybody's interested in putting on counter trend exposure, but counter trend exposure, unfortunately, is just it has lower probabilities of working because you're fighting a trend. So I think the right thing to usually assume is that the trends will stay in force. And if you can be a bit of a trader, short-term oriented, you might be able to capture some great relief rallies at time, but it's more difficult.
Totally understand. And so I guess the last question here really comes down to what are you doing about this, right? Like you talked about the ETF a little bit. I think this ETF you have is very defensive in nature. Would you mind walking me through how a average investor would begin to look at your ETF, define it? What kind of category would it fit inside of their overarching portfolio?
Yeah, for sure. I mean, so what we think about initially is, well, if we don't have the ability to go buy an S&P 500 type of proxy like SPY, which is an ETF that a lot of folks have in their portfolios. If we feel like there's downside risk, well, we want to consider other asset classes, and that can be somewhat sophisticated. So other asset classes would be things like gold or silver, treasury bonds. And we believe that asset allocation of that nature is appropriate when we have a downtrending equity market, and also with attention to sector rotation, because what we do tend to see is downside leadership comes from the more cyclical sectors of the market when we're seeing the market overall trend lower, and you tend to get outperformance from less cyclical sectors, that utilities and consumer staples and real estate. And we developed the ETF, which is called TAC or TACK. to try to have a conservative approach to U.S. equities by investing in sectors of the market that have long-term upside momentum and are exhibiting upside leadership, but then also having the ability to move automatically into these what we consider to be risk-off categories, including gold, short-term treasuries, and long-term treasuries. So we've created this portfolio that is dynamic. It rebalances monthly, and it invests first and foremost in sectors, but then has that risk-off piece to it. As it stands, TAC is invested in those defensive sectors, so consumer staples, utilities, real estate. It also has a piece in energy, which is one of the few areas of the market that seems to be working right now from a momentum perspective. And then it has about a 50% piece in those short long-term treasuries and also gold. So right now it does lean very defensive, but there are times at which it will go back to a more offensive stance in terms of its positioning, based simply on the price action in the marketplace. So, and for the average investor, it's very easy. You can just pull it up in your broker-dealer account or in the online brokerage account, and you'll find information there. And that we have a fund website that's fairleadfunds.com.
Fairleadfunds.com. Everyone, go check out fairleadfunds.com, and also go to your favorite online broker. I use Public, and if you're not using Public, you should go check out Public. But type in TACK, and you will find this incredible ETF that I'm excited to learn more about, dive deep into, and hopefully become a shareholder in.
Thanks so much, Austin.
This was a lot of fun, Katie. Thanks for joining me. And everyone, don't forget, fairleadfunds.com. Go check out TACK, and I can't wait to have you back.
Same here.
See ya.
Take care.